Today I would like to analyze Docusign, one of the largest software companies in the world, and we can see here the stock price is down around 15% in not many days. So the reason for that is the earnings. Actually, the earnings were quite good. So the expected earnings per share was 81 cents. They announced around 90 cents. The revenue also was higher than expected, but the billings for the next years is lower than expected. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 15.24 billion US dollar. This makes Docusign the 67th largest software company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2021, the revenue was around 1.45 billion US dollar. This was a strong growth around 49% from 2020. In 2022, we saw the strong growth again around 45%. In 2023, we saw the very good growth around 19%. And in 2024, we saw the good growth around 9.7%. So overall, I think we had a very good growth in the last 5 years, so as a check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2021, the free cash flow was around 0.21 billion US dollar. This was an incredible growth around 390% from 2020. In 2022, we saw the very good growth again around 107%. In 2023, we saw the slight decline around 3%. And then in 2024, we saw the very good growth around 106%. So overall, we had the incredible growth in the last 5 years. So it's a check here as well. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 0.89 billion US dollar. We're going to divide it with the current market cap, 15.24 billion. And then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 5.83%. And that's a very good free cash flow yield. Actually is over the 4%. So as a check here, we like to see that. We can also take a look at the free cash flow assumptions for the next years. In 2025, the free cash flow could be around 0.92 billion US dollar. In 2026, around 0.93 billion US dollar. And in 2027, around 1.05 billion US dollar. So let's just assume for 2027, the 1 billion US dollar. Then we're going to get the free cash flow yield for 2027. So the number we're going to get would be around 6.56%. And that's a very good free cash flow yield as well. It's over the 4%, so it's also a check here. And this can be an indication for undervaluation already. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here in 2024 around 120 million US dollar. Then we're also going to take a look at the short-term debt. In 2024 around 22 million. So then we're going to divide this number with the current free cash flow, 0.89 billion US dollar. And then we're going to get the debt to free cash flow ratio for 2024. So the number we're going to get would be around 0.50. And that's a very good number actually. It doesn't take many months to repay the debt with a free cash flow. So the check here, we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 1 billion US dollar. And that's a very good amount as well. We like to see that. So it's a very good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. So this is the current market cap, 15.24 billion US dollar. We're going to add the debt as well, 0.142. And then we're going to take minus the cash. So the cash is around 1.05 billion US dollar. So then we're going to get the enterprise valuation, how much the whole company is worth. So the number we're going to get would be around 14.33. So this number we're going to divide with the current free cash flow, 0.89 billion. Then we're going to get the ratio that we're looking for. So the number we're going to get would be around 16.10. And that's a very good number, actually. It's under the 25 that we're looking for. So it's a check here. It can already be an indication for undervaluation. Then we can also calculate this number with the free cash flow assumptions of around 1 billion. So then we're going to get a different ratio. So the number we're going to get would be around 14.23. And this is look even better for 2027. So it also would be a check here is under 25. So overall, I think this company has a very good valuation at the current moment. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look, and what we can see here, actually the shares outstanding increased in the last 10 years. We can see sometime even over 6%. But this is also understandable if you have a young company, because they need a lot of money to invest in the business. But now in 2024, we see the shares outstanding decreased. And we also can take a look here. This company announced a stock buyback around 1 billion US dollar. So I think this is something very positive. And I would say it's a check here as well, because in the future, they seem to buy back more of the shares. Can Docusign stock be a good buy right now? The stock price decreased around 15% in not many days. And also if we take a look at the 5-year charts, we are down around 46%. So let's start with a positive about this company. We had a good revenue growth in the last 5 years. We had a great free cash flow growth as well. This is something we really like to see. The balance sheet is also looking very good. We have a low amount of debt and a good amount of cash on hand. The free cash yield around 5.83% is also quite high. We like to see that. In 2027, with our free cash flow assumptions, the free cash flow yield would be around 6.56%, which would look even better. Our enterprise valuation to free cash flow ratio around 16.10 is also very good. We like to see that number under 25. So this would be an indication for undervaluation. In 2027, this ratio would be around 14.23. So this would look even better. What I don't really like to see about this company is a stock-based compensation. So if we're going to take a look here, we can see the stock-based compensation was around 0.6 billion US dollar in 2024. That's a huge amount actually. If we compare it with the current free cash flow, so the free cash flow in 2024 was around 800 million US dollar. So this is a huge amount of the stock-based compensation. So this is not in the free cash flow actually. The stock-based compensation is like a hidden cost actually, and we could not have this in the free cash flow yield as well. So overall, I think this is something I don't like to see, that the stock-based compensation is so high. So I wouldn't buy the stock at the moment. Even the free cash flow yield and the enterprise valuation to free cash flow ratio looking very good. But overall, I think this company is not a good buy right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.